I think I fall somewhere in the middle. The general consensus is now very bearish on housing. The idea is oversupply. Demand just totally froze up because the rise in mortgage rates
Uh-huh.
just completely froze, and that's all real. Whereas I think Harris Kupman focused on the longer term, and I tend to agree with that view. I'm not as bearish on the broad U.S. housing market as I am on other things, at least in nominal terms. Certain zip codes certainly way overdone. You had certain, you had certain cities had major booms. You had local pockets where you had just euphoric bidding for housing. Bids would come in just super fast. You have more bids you know what to do with. You sell way above your initial price. I think that's behind us, and that's going to stay behind us. But I do think that when you look at nationwide average nominal housing prices, I don't really expect a big downturn. I mean, you could have a dip, you could have things like that, but I expect more of a stagnation. And so if that trends sideways in nominal terms, that'd be going down in real terms. If it trends mildly up in nominal terms, that'd be flat in real terms. And that's more the environment that I see. I think that the excess will come off, but that I think that it'll return to, okay, what pockets are underbuilt and what pockets are overbuilt. So it's very zip code dependent. I also think that due to what I said before, I think by the time we get to 2023 or so, I think the Fed will probably have paused. And I think we'll see probably a reduction in mortgage rates and potentially long duration treasuries. And so I think that that'll ease the market to some extent. The interesting thing is when this happens, right? So mortgage rates spiked, so obviously demand dried up, but also sellers dried up. Because if you have a home and you're thinking about moving, you really have to think twice about that now. Because if you sell your home and then you buy another home, you're going to have trouble getting financing on that at any sort of reasonable rate. Basically, you're either going to get the same home for like the same type of, the same price of home for a higher monthly cost, or you're going to have to settle for a less expensive home for the same monthly cost. So even sellers have less of an incentive to sell in this type of market. So I think that it's more about the market being frozen than anything else. And so I kind of have a neutral, choppy, sideways view on the market and kind of a very zip code dependent view. Different markets have different nuances. So in the United States, we pour our capital into stocks rather than real estate for the most part. And then the foreign market, they pile their capital into U.S. stocks. Kind of our capital markets are like the crown jewel of what we optimize for. Whereas a lot of the global markets is the opposite. They don't invest heavily in their stocks, but they invest heavily in their real estate. And so when they have asset bubble, it's more like in the real estate market. And China has really been, I think, at the core of this because Chinese consumers heavily prefer real estate investments over stocks. They also like things like gold, physical metals, but really the bulk of it is real estate. And because real estate prices are so high, as well as because many of them want jurisdictional diversification to the extent that they can get it, they want to go outside their country. So they buy real estate in Australia, they buy real estate in Southeast Asia, they buy real estate in Europe, they buy real estate in Canada. Especially Australia and Canada, they really influence those markets because they're not really huge markets when you think about it compared to China. And so that combination of the domestic cultures investing heavily in real estate and then foreign buyers coming in and bidding up real estate, I view those markets as rather overvalued. In a similar way that going into this year, I viewed U.S. equities as overvalued. Whenever foreign capital is heavily pushed into one area, I get quite concerned when you combine that with high valuations. So I've been concerned about U.S. equity valuations, and I've been concerned about Canadian, Australian, Chinese real estate valuations. So, I would take U.S. real estate over many other countries' real estate. But at the same time, I would seriously consider, say, value stocks outside of the U.S. compared to some of the S&P 500 that we see in the U.S. Things that are under-owned, but that are still chugging along and doing pretty well. I've been known as a bond bear, more of an inflationist. I've been, since, I kind of hinted at it in 2019, and once we actually got the stimulus in 2020, I've been firmly in the inflationary camp, and not really just transitory, kind of multi-year inflationary camp. And so I've been obviously avoiding long duration treasuries, sticking to real assets, and to the extent that I hold defensive assets, it'd be like gold and cash. But when you have a record bond sell-off, I mean, the first half of this year was absolutely disastrous for mid to long duration bonds, and you started to get treasuries at 3%. I started to take a somewhat contrarian interest in bonds, which again is coming from a structural bond bear. And it doesn't mean I want to hold them for 10 years, but it means on a 6 to 12 month basis, I view that the risk reward of owning intermediate term and semi long term bonds was attractive. I can't really bring myself to buy 20 or 30 year bonds, but the kind of the 5 to 10 year range became quite attractive to me on a risk adjusted return basis. And I still think that's probably true. I mean, we have yield curve inversion, we have clear economic weakening. And so even though the whole yield curve is submerged below the prevailing inflation rate, I think that for a defensive part of a portfolio, that's now a useful hedge against disinflation. And so I'm no longer, at least in the near term, opposed to bonds in the same way that I was. I think there's still risk to the view. The fact that the Fed's trying to sell bonds, or let them roll off. The fact that we don't see a lot of foreign demand outside of kind of individual auctions, and just treasury market illiquidity in general. But I do think this is probably going to improve at some point, especially with some sort of Fed pivot. So I think that it depends on the way that an investor or a trader manages their book. But for example, I generally manage it on a dial rather than like a on and off switch. And so, for example, going into this year, I often wrote that with the Fed trying to do QT and raising rates and PMIs rolling over, I was somewhat defensive. I was like, okay, I like energy, I like healthcare stocks, low volatility stocks, I like some, certain consumer staples, things like that. Now that we've seen, kind of a small bloodbath in equities. I mean, there are blue chip bank stocks that are down 35%. There are dividend aristocrats. I mean, if you look at Stanley Black & Decker, right? It's this company has raised dividends every single year since Lyndon B. Johnson was president. That just had a 50% drawdown in its stock price from historically high valuation levels to moderately cheap levels by its average history. And so I do think that with the carnage that we've seen, at least in some pockets of the equity market, that it is more interesting than it was 6 months ago. And so without trying any sort of, call a bottom, I have been shifting a little bit of capital back into it. Again, because for me, it's kind of this dial. I mean, if you have euphoria, I pull back a little bit. If you have, pessimism, I kind of dial into it a little bit, lean into it a little bit. What we've seen already is the big multiples contraction. The big thing going forward is whether or not we're going to have big earnings contraction. And so that's the key risk, I think, going forward. I did a back test on, a century of looking at inflationary spikes of this magnitude, high single digits, double digit inflation, and what happens with corporate earnings. For the most part, you have weak earnings in real terms, but kind of choppy sideways earnings in nominal terms. I mean, when you have 9% inflation and, you just had huge money supply growth, it's hard to really have like a big sharp drop in nominal earnings if you're a reasonably healthy company. But instead you have more of a malaise. I mean, your revenue's going up, your expenses are going up, your margins are getting squeezed a little bit. And so you kind of chop along sideways, which is not great in real terms. And that's kind of how I'm modeling a base case here, that I don't really expect super bullish stock action. I think stocks, broad stock indices could be range bound. I think that, earnings are going to broadly be disappointing, maybe not catastrophic, but disappointing. And the high quality businesses that have already fallen 30 to 50%, that, many of which pay dividends and things like that. I think you could certainly start leaning into those, as long as you have a long-term mindset and are prepared for the volatility that can come with the scenario where the Fed is still tightening policy into an economic deceleration.